In my career, I have seen the S&P 500 go down 40+% 3 times over the course of the last 25 years. That's what I call and characterize as a market crash. Today, we're going to talk about what a market crash looks like, what the opportunities are, how to prepare for it. Hi, this is Finance Dad, Shalabh Garg. I've had a 25+ long career in Wall Street. I've worked at a bank, I've worked at a hedge fund. I currently run my own hedge fund. And today's topic, we'll talk about a market crash. And there's also a reason why I want to talk about a market crash, because I feel like one is coming. So hence, I want to prepare you for it. So let's start with the definition, because being an engineer, how can we start something without defining it first? To me, there is only one measure of a market crash. There's 3 features of such a market crash. 1, it always takes stock market down. Second, it's not a blip. It tends to last for a while. Third, everybody can point out to a reason, at least ex post, as to why such a crash occurred, and everybody has a reason as to why it will never recover. Hint, hint, it always recovers. But those are the 3 key features. In my career, I've seen that happen with the S&P 500 3 times. One was 2001, 2002, when the tech bubble crashed. Second was 2008, 2009. Everybody knows about it, financial crisis. Even if you're young, you probably have someone in your family that has at least observed it, or has, if not observed, has seen someone being impacted by it. And third, 2020 COVID. And in all 3 cases, as you would know, you can point out as to reason why. 2001, the valuations of tech were very high, and companies that were not making any money were trading at 200 PE. It made sense that the market crashed. 2008, financial crisis, Lehman Brothers went bankrupt. All these banks were going bankrupt. Made sense that the market crashed. 2020, we were never going to get out of our houses again. COVID hit, a virus that nobody knows, the market crashed. In each of the 3 cases, the S&P 500 was down at least 40%. And it lasted in that drawdown of 40% for multiple months, at least 18 months or longer. So it was not a blip that it came and it went. So why am I saying that? Because what happened this April, the 21% that happened in S&P 500, which is almost already recovered, that's not a crash. A crash is something that impacts you, that stays with you, takes a long time to recover, and almost in every case has a policy behind it, a policy action behind it, whether it be the Federal Reserve cutting interest rates, or it be the fiscal programs where the government is injecting more money, giving people tax breaks, doing something or the other to resuscitate the economy all over again. And in each of the cases, S&P was down 40+%. In general, it requires an external event or an external factor, but also it's generally an ongoing process. So in other words, it's been in the making for a while, some major news hits, and that major news ends up being an immediate catalyst behind that crash, but it's not an overnight event. It's in the making for a while. And that event only acts as a catalyst, is not the entire cause behind it. Even in 2020, where COVID was the immediate cause, the makings of it was there for a while, because the Federal Reserve had been raising interest rates, leverage had been building up, and COVID acted as like a spark that sort of brought the camel down and led into a crash. There is one other feature that is associated with the crash, which is rise in unemployment. There is no crash that happens where people are not losing jobs. Either people have been losing jobs ahead of it, around it, or after it. It's not going to be the case that the unemployment rate will be at 4% and the market will crash 41%. That's just not going to happen. But why? Because that is just how it is. One person losing their job impacts 7 people. Their gardener, your massage person, your trainer, your people that work in your home, people that you employ, people that you're employed by. Everybody around you 6 or 7 times loses their jobs, creating a ripple effect of multiple people losing their jobs, and hence unemployment always goes up. It's not the case ever that unemployment is going down and the market is crashing by 40%. In 2022, market did go down. I'm not saying that corrections don't happen. Equities did correct by 20 or 22% in 2022 over a course of 12 months, but unemployment did not go up, and lo and behold, market almost immediately came back. That crash that I'm talking about almost always, not almost, always is pari passu with an unemployment rate going up. So you will feel it, you will observe it, you will know it, and it will not come as like a surprise to you that, oh, I didn't even know there was a market crash going on. You will be impacted by it either positively or negatively, whatever your situation may be at the time. So are we approaching such a crash now? To me, yes. Unequivocally, yes. All the makings of such a crash one that lasts for a while, that is 40% or more, one that leads to unemployment going up or at least is parallel to it. All the makings of it are there. Why do I say that? Interest rates have been high for a long time. We've had mortgage rates at 6.5 to 7.5% for a really long time, which has impacted housing. We've had, yes, tech has done well, but it's not like tech is continuing to do well at such interest rates because the price of leverage is high. At the same time, all the savings from the COVID time, that the fiscal benefits and so on that the government injected into the economy have run out, and people have reuse their savings and use their credit card delinquencies are at the highs. So all the makings that accompany a crash are there. The external factor that precedes it in the form of tariffs is already there. Now you could say to me, well, Trump has already withdrawn the tariffs and it may be it doesn't matter anymore. The cat is kind of out of the bag. It's not like a business that's running with supply chains all over the world is ever again going to be confident in those supply chains. The impact on those supply chains has already been had. If you're an auto company based in Detroit, you've already made plans into the future to create supply chain and an environment where you can maintain, you can exist without getting your parts from Mexico or getting your parts from China, because it's just too risky. God knows what may happen tomorrow. A business cannot operate that way. So in some extent, the cat is already out of the bag. Now, to that people say, well, does that not mean that inflation will go up? Does it not mean prices? You know what? Inflation is a two-edged sword. One side is supply and second side is demand. I remember in 2008, 2009, price of crude oil went up to $150 a gallon. Very, very high prices. And people kept saying that at such prices, at such high prices of crude oil, gasoline at the pump will be so high that inflation will stay high forever as a result of the prices of those gasoline. What the people did not plan for at the time is that the US demand side for things tends to be very elastic, in the sense that prices go up and demand crashes. Demand for gasoline at the time crashed. People started to drive less. People started to take less holidays. And before you know it, price of crude oil did not just come down, ultimately went from $150 in 2009 to all the way to ultimately going to negative around COVID time. That's how much the big crash in crude oil prices over the course of 10 years that occurred. The reason I say that is to make the point that inflation has two sides. One is supply, but the equally important part of it is demand. This presumption that prices of things will go up because producers will pass on the prices or the price of tariff to consumers presupposes that the consumers will not make alternative plans, or consumers will not reduce their appetite or the demand side of their things. That is not true. American consumer is very smart, and once demand goes down, it stays low for a while, because a typical household makes plans for the long run, not for tomorrow. They're not saying that I'm going to make this change in my consumption habit to consume a little less of this, consume 20% less of this to accommodate the higher price. Then it's not going to be that the price comes down by 10% and they immediately increase it again. So when demand gets destroyed in an economy, it stays that way for a very, very long time. So you could find yourself in a situation where suppliers or the producers are not able to price or to pass on those high prices to the consumer, thereby inflation continuing to stay low and actual profit margins coming down. So that is the point around inflation. So that in margins coming down at the same time, so that external factor around tariffs with here, the impact of it is already been had and it's not going away anywhere. So hence, for me, the high interest rates, tariffs, then overall high valuations. Valuations is never a good reason for the market to crash, because valuations can stay high for a very, very long time. But combined with these other factors, all the makings of an impending crash are in front of us. So I am calling for a 40% decline from the 6,200 S&P high that it made in February of this year, that will take it to 4,500 or so level. With that background laid out, the most immediate questions every one of you is going to have is what to do and what not to do, right? Market crash, we've seen them in the past. The key thing to know about a market crash is that it's a crash and not the change in trend. In other words, whatever levels the market leaves behind will be a buying opportunity. And over the next 20 years, 30 years, 40 years, your children, you, and if you're young then you, and if you're older than your children, will enjoy similar market gains as the last 100 years before that. So a market crash is not a reason to worry, it's an opportunity. Now, when it is happening, it is very scary. Why is it scary? Because most likely, if you've not lost your job, then people around you, your friends, family, people that you care about have lost their jobs. And that is a scary situation to be in, because you have to plan for living a life with no incoming paycheck, dip into your savings, and there is a tendency at that time to not take risk. And that's what I would advise against. A market crash is the one big opportunity of your career. A typical career, if you're late 30s to early 40s, will not have more than one market crash. If you're lucky, two, but more likely than not one. In my career, it is true that I've had two or three, but I ended up joining right at the cusp of the first one, and I didn't even know much about the market at that time, 2000, 2001. The second one, I was smack in the middle of it, and the third one, COVID, happened when I was at the peak of my career. I took the most advantage of the third one. At the time of COVID, when a 40% correction did happen, I bought aggressively at that time. Now, you could ask me, well, what am I supposed to do with what I'm long right now? If you don't have leverage, just let it be and just keep buying power. Keep a portfolio that is 60 to 70% invested and 30 to 40% in cash, or maybe 50% invested and 50% in cash, knowing fully well that you're going to invest that 50% in cash aggressively if and when that correction or a crash was to occur. What is it not to do? Never ever sell a down market in the US equity market. Ever, ever. No matter the news, no matter the circumstances. Even in Pearl Harbor, when the Japanese attacked Pearl Harbor, Dow Jones, after going down for 1 month, went up for 20 years thereafter. Selling after a news is out there is never a good idea for the S&P 500. You always want to buy when the news is up. There's always a reason exposed why the market is down. So it's not going to be that you're not going to tell why the market is down. But when it is down, make sure to augment your positions. It is true that buy and hold S&P has given you 7 to 8% annualized return over a very, very long period of time, maybe 9% return over a very long period of time. But if you caught even one of these 40% crashes, then 9% becomes 15% annualized return. That is how valuable it is for you to invest post or into that market crash, in addition to investing some every month in your 401k or otherwise that you may otherwise be doing. A down market crash is also a fantastic opportunity for a change in jobs or for taking more risk with your career. Because it's an environment when unemployment is going up, it's an environment where companies are hanging on to their most important and valuable employees. It's an environment where people are just hanging on to whatever job they can. If you have capital to take risk, if you have a young career to take risk, it's a fantastic opportunity to do that. People, for example, after the financial crisis, who joined private equity then, did fantastically well over the 20 years thereafter. Right? People who were on the bank side left that, joined private equity. Amazing. It's not a great opportunity to join private equity right now when everybody knows about it, but it was a great opportunity to join private equity 2000. Same for tech. If tech has a pullback and big tech companies are firing and reducing headcount, it may be a fantastic opportunity to take that risk and join that. It may be a fantastic opportunity for an entrepreneurial person because capital is scarce. Everybody's trying to preserve whatever job they may have. In other words, it's an amazing opportunity that crashed both in the investment portfolio side and also at your personal level. Of course, I'm a consultant too. So if you want to talk more about any of these topics, reach out to me on the box below, email or any other way, and I'm happy to guide you how to prepare your investment portfolio, how to prepare your career better, to prepare for that crash and what opportunities may come up along that way. That's my episode for today. Please join or subscribe. No, what? Like, comment, and subscribe. Please like, comment, and subscribe. It helps me grow my podcast. With that, this is Finance Dad signing off. See you next week. Bye.